Okay, welcome back. This is Business353 Lab number 7 for Chapter 7 in the lyrics version of the text. And here we are doing two things. We're completing the table for FIFO and moving average, ending inventory, cost of goods sold, and gross margin, which is very similar to the last question. And then we're going to record journal entries for the moving average numbers. So every time we make a sale or a purchase, we're assuming it's a perpetual system. So we would be able to infer that from the fact it's talking about the moving average calculation rather than the weighted average. It says all sales and purchases are made on credit, so that means accounts payable, accounts receivable. It says enter an appropriate description, which doesn't really matter in lyrics, but we could just refer to the date, or well, I guess we already have the date in the journal entry, so we could just put in purchase beginning inventory. Actually, beginning inventory, we don't need to make an entry for beginning inventory because it's already there in the accounting system. Alright, so FIFO, we have in the table up here, we have beginning inventory of $3,000 at $3. We made one purchase on the 7th of February, a sale on April the 9th, another purchase on the 1st of May, another sale on the 9th of June, and another purchase on the 27th of July. Hopefully they're making other sales of other kinds of inventory because that's not a lot of activity for a business, but we'll just work with that. So ending inventory, we count backwards for ending inventory and we count forward from the beginning for cost of goods sold. The oldest stuff gets sold, the newest stuff gets kept. So we should figure out how much is in our ending inventory as part of the calculation. So if we kind of track our way through here, we have 3,000 plus 12,000 that we purchased, and then we sold 8,000, so that's 15,000 minus 8,000 leaves us with 7,000. We added another 7,000, giving us inventory of 14,000 units. From that we sold 9,000, leaving us with 5,000. And our ending inventory then would be the 5,000 left over there plus the 4,000. So ending inventory is pretty easy to calculate. We have the 4,000 at $4, plus we have 5,000 of the next oldest, which is 3.6. So that's the value of our ending inventory under that method. Then cost of goods sold includes 12,000 units, includes 8,000 units sold here and 9,000 units sold there. So those are the oldest 17,000 units. So let's calculate those. 3,000 units at $3, and then we have another 12,000 units at 3.4. So that adds up to 15,000, and we need a total of 17,000. So we need another 2,000 at the next purchase at 3.6. So our cost of goods sold is 57. Now our gross margin is simply going to be the two sales, so 9,000 at 12 plus 8,000 at 12.5 minus the cost of goods sold, which we have listed there as 57,000. All right. Moving average is a little trickier because we have two sales, and every time we make a sale we have to calculate the moving average at that time. We could actually pull up a spreadsheet to do this, and maybe we'll do that. Let's pull up a spreadsheet and see if we can use that. I would like to move it out of my way. I'm not quite sure why I can't move it out of my way. What happens if I click on that? Okay, that's not really what I want. I'm not sure how I can move that out of my way so that I can, I don't know. Oh, that didn't work. Alright. This is a little different, okay? Click the pocket button. Oh boy, this is like Mozilla stuff. It's not really helping me much. Okay. Drag it down this way. Oops. That didn't work. Alright, I'm not really feeling the spreadsheet here. Okay, it turns out that it was my recording box that was the problem. Let's see if we can get my spreadsheet. There's our spreadsheet down there. You can just grab the top. So you shouldn't have the same problem as I have, because you don't actually have to record a video for anyone. So, right there. Oh, okay, interesting. Oh, I'm not quite sure what's happening here, but we have a standard size for the spreadsheet box, apparently. Alright, so anyway, we are going to work through the calculation here. We're going to start with the beginning inventory. And there we have 3,000 units. And I can use the tab button to move through this as I recall. So that's worth $9,000. Okay, then we have purchase one, so we'll call that P1. And we're going to purchase 12,000. And it's going to be at 3.4. So then we do 12,000 times 3.4. So our next purchase is 40,800. And then we have sale 1. And so sale 1. And this is a what's the best way of doing this? Let's put the sale over here. Minus 8,000, and that's at 1250. But we need to figure out what the inventory effect is. So we should have a balance column over here somewhere. So let's put a balance bit there. Okay, I have to cancel first. Balance. Alright, so the balance of the first one, opening inventory is 9,000. And then we end up with 9,000 plus the new 40,800. So we have 49,800. And what is our total number of units at that point? Let's go units. The first one we have 3,000 units. And then we have 15,000 units. And then we have 7,000 units. And then we have purchase number 2. And then we have sale number 2. And then we have purchase number 3. Alright, so let's purchase number 2 in here at 7,000. And 7,000 units at 3.6. And then of course we need 7,000 times 3.6, except I just put in 3.5. There we go. And then we have a sale of 9,000 units. Okay, and then a purchase of 4,000 units. For $4, 4,000 units for $4. Alright, so after we have this 7,000, then we add another 7,000, and then we subtract 9,000. And leaves us with 5,000, and then we add 4,000. Oops, let's just go 9,000. Okay, which I think is consistent with our ending inventory calculation for FIFO up here. Okay, yeah, 4,000 and 5,000. Okay, don't change anything. Find our spreadsheet again. Alrighty. So after the 8,000 units are sold, we need to figure out what the cost of those units are. So we're going to put that into the cell right here to calculate cost of goods sold. But we need to figure out if we have 49,800 over 15,000, then the cost, the average cost, is just the dollars here divided by the units. And so I'm not sure if we can do that here, but let's do that. 49,800 divided by 15,000. So an average of 332. So we could call this average if you like. So $3.32 is the number that we're going to apply to the sale here. So let's just drag that down in there, and then we're going to multiply that by the 7,000 units. Okay, then put it in the wrong place, didn't I? I want to put it actually over here. So we multiply that by the 8,000 units we sold, and our cost of goods sold for that sale is $26,560. Now the 332 here, same number, we multiply by 7,000 because that's the amount we have in inventory. And so if we were to do the calculation again, that divided by that should also be $3.32. So we're going to calculate the average cost at every time that we actually make a sale. So next we buy some more. So we're getting a little short. Add another 7,000 units at 25,200. So we can just take this number and drag it down there, and then edit it, go to the end and add the 25,200 that we purchased. So we now have 14,000 units at a cost of 48,440, using the average for the first 7,000 and then the actual cost for the next 7,000. And then we have a sale. So every time we make a sale, we have to calculate the average cost. So let's do that. Drag that 48,440 over there, and then go to the beginning, put in a bracket, go to the end, put in a bracket, and then we need to divide by the 14,000 units. So let me see if I can drag that somewhere where you can see it. I'm sure I can. Okay. I can. Okay, so it's 49,800 divided by 15,000. The average cost is 346, multiplied by the 7,000 inventory after the first sale, plus another 25,200, which is the new purchase on purchase number 2, and then we're dividing that by 14,000 units. Okay, so now we can grab that and pull it over here, and pull it over here. And so now the 346 gets multiplied by the 9,000, so we can go either to the home, to the front or the back, and multiply that. Whoops. So 9,000 units at that price gives us 31,140 as our cost of goods sold. So you're probably all wondering why I don't put cost of goods sold up here. That's a very good question. This is a sale. This is a enter. This is a perch. Okay, so now we have to take the 346 and multiply by the 5,000 over here, because we have 5,000 of inventory. So 5,000 units times that price. Okay, so 17,300 is our balance after that sale. Alright, so we can drag that down here. And once again, we're going to need to put a bracket at the beginning and a bracket at the end. And then we're going to add to that the new purchase of 16,000. And that will be our ending inventory amount. We can calculate the average, but we don't really need that. Now we can add up the cost of goods sold. So we can do that right here. 26560 plus 31,140. And then all we have to do is take these numbers and put them up into the appropriate places up here. I don't think I can actually drag from the spreadsheet to the table, so let's just remember cost of goods sold 57,700. 57,700. Okay, click on the spreadsheet again. We have ending inventory of 33,300. Let's put that in here. And once again, in this special circumstance where we have the beginning inventory the same, we can actually determine that the cost of goods available, which is what we split between the ending inventory and the cost of goods sold, should add up to the same amount. So this one, we've got 34,000 plus 57,000, and that adds up to 91,000. Here we have 57 plus 33, which adds up to 80, plus another 1,000, so 81,000. We're good. The gross margin is going to be different, of course. It's still going to be 91,000 times 12 plus 8,000 times 12.5 because that's the selling price. But now the cost of goods sold is going to be different. So delete that and put in 57,700. So if I drag that to the side here, you can see it's the sale of 9,000 units at $12 and plus the 8,000 at 12.5 minus the 57,700 of cost of goods sold. Alright, so we're well on our way. The beginning inventory, we don't have to do anything with that. Well, we're recording journal entries now, so let's go 7/2. How's that? That even works. So we're adding to inventory here. So inventory gets debited for, well, we could have we could actually see our spreadsheet. We have that number, but let's just multiply it out. 12,000 times 3.4, and of course that's the same as the other side. We have an account payable. Oops, we have an account payable for that, and we call that B1, or whatever you like to call it. Although the lyrics just cares that you have something there, not what you have there. Okay, what did I just do? I'm trying to put in a date, so 9/4, April the 9th. We made a sale, so obviously we have some account receivable there, and then we have sales, and then we have, I'm thinking Derek probably wants me to put a cost of goods sold entry in. Okay, so we have a purchase, a sale, a purchase. Yeah, okay, I think so. So let's just drag the 9th of April down. This is S1, the sales side, and of course that is 8,000 times 12.5. And then of course we have the cost of goods sold side, because we actually have the value that we have calculated. So cost of goods sold, this is the average one. Let's go back to the spreadsheet. We have to get back to the spreadsheet. The spreadsheet tells us the cost of goods sold for that one was 26,560. So let's remember that, because as soon as we click on it, it's going to be gone. 26,560. Let's check. Yep, 26,560. Of course, the inventory goes down by that amount as well. And just drag it over here. And this is cost of goods sold one. Sure, why not? And then the 1st of May, 1/5. We bought more. So we have inventory. And we have accounts payable. And we have P2, purchase 2. The amount of the purchase is going to be 7,000 times 3.6. Drag that over here, and so we go. Then we have sale number 2 on the 9th of June, and so we're going to have accounts receivable, we're going to have sales, we'll have well, I guess we don't really need to do that. It's probably just whoops, stop. Cost of goods sold, next entry there. Whoops, what happened? Inventory going down. There we go. I grabbed the wrong one. Cost of goods sold. There we go. And this also is the 9th of June. So this is S2, and this is cost of goods sold 2. And so the accounts receivable in this case, oops, I'm going to hit enter. The accounts receivable goes up by 9,000 times 2, which is the amount of the second sale, but it's not, times 12. Okay, so 108,000. And then the cost of goods sold, let's pop back to our spreadsheet. Get your memorization System working. 31,140. 31140. Let's check. Yeah, 31,140. And so here, type it in again if you like. That's the cost of goods sold, and then we have the last entry on the 27th of 7, and that is the last purchase. So we have the inventory, we have the accounts payable, we have the, whoops, that didn't exactly do what I wanted it to do. So inventory goes up, accounts payable goes down. This is P3 for purchase number 3, and the amount of purchase is 4,000 times 4. Okay, let's check everything. Looks like we got it all here. We've already checked that these two, the ending inventory plus the cost of goods sold, adds up to the same number. I think we've checked everything from our perspective. Let's see what Lyrics thinks. That's a lot of pleasing green. There we go. So we're done.